So Dhruvil, I'm going to get into my host mode. First is creating value for you, your shareholders, your company, your employees, and then there's wealth creation for your own self. You have invested in 50 plus startups, in some 50 plus public companies, you've invested in a few funds, you have 10 plus real estate portfolio.
Dhruvil Sanghvi from a Gujarati business family graduates Carnegie Mellon, joins Deloitte, quits Deloitte.
Known for his strategic vision and operational acumen, Dhruvil has refined logistics technology landscape.
Dhruvil Sanghvi
Loses his American visa, comes back to Mumbai and founds a business.
What has been your investment thesis?
Elon Musk has compounded his wealth at 35% over 25 years. Buffett has compounded his wealth at 32% over 50 years. Right? But at LogiNext, in a bad year, we make 50% returns.
The history with all its ups and downs is going to speak about fundraising. And you said, Anu, I was fundraising for 9 months unsuccessfully. And you said at one point in time, you were in front of one of your investors and you cried.
The feedback they shared on why they could not invest in me was that I am not a CEO they see that can be a public CEO.
Approximately what would be the valuation of LogiNext today?
And there's nothing called as work-life balance, right?
Oh my God! Unpopular opinion.
Work-life balance is for the weak.
Actually have a session with Lipi. What it really took for her to be with you for all these years. There's so much that is spoken about founders' depression. Oh my God, founders go through so much. But I'm sure there are challenges of being that founder's spouse as well.
There were days when I felt that I can never talk about my problems because they are never big enough.
Emotionally extremely self-regulated. Extremely. Like the most self-regulated person ever I have met in my life. Ever. She's that COO that every CEO wants.
Oh,
right?
What a lovely... Hello and welcome to the yet another new episode of The Talk Lane. Today, I am joined by a prolific founder and a very dear friend, Dhruvil Sanghvi. Dhruvil is founder and CEO of LogiNext, the SaaS unicorn revolutionizing logistics and field service optimization. Under his leadership, LogiNext served over 200 enterprise customers globally and processed more than 500 million packages annually till date. A Carnegie Mellon alumnus, Dhruvil is also a prolific investor with portfolios spanning across 50 plus private companies, 50 plus public companies, 5 plus funds and 10 plus real estate portfolios. Some of his notable ventures include Inc42, SpendFlow and Vested Finance. Known for his strategic vision and operational acumen, Dhruvil has refined logistics technology landscape while expanding his influence as an active investor in India and in United States. Dhruvil, hello and welcome to the Talk Lane.
Thanks for having me.
Yeah, I think this was like very formal, professional introduction of yours. I have to do a personal introduction of yours and how I have known you over the years.
You should, because even while you were speaking about my professional intro, I found that too boring for myself, right? So I think we should definitely spice it up a little bit. And who would have thought that we would be talking in New York City today, recording a podcast?
Absolutely.
Right?
So Dhruvil, if you remember, I first reached out to you in 2016 or 2017 when I was starting my first venture, EFI Hub. You were one of the first few board of advisors that I had for that venture. And I don't know if you remember this or not, but there's a little reason, or there's a little your effort or your hand in my media stories being out there overnight, even before my startup really took off. So for many who do not know, when I started EFI Hub, when I approached him and I said, can you please be on the board of advisors? This is the initiative. This is what I'm working on. And Dhruvil, he's like, yeah, sure, I'll be on board and just send me and, send me the details and let me know whatever I can be involved with, how, blah, blah. And I was like, sure. And then a few hours later, he emails me back and he says, by the way, this is an amazing initiative and you partnering with so many amazing founders, we should do PR around that. So I was like, yeah, okay. Yeah. And then he connected me with his then head of marketing, Sharjil. And Sharjil goes like, Dhruvil has said we have to do all these things. So I was like, okay, but I don't even know how it works. He said, don't worry, we'll take care of that. I remember I was in my early days of starting journey. And even before my startup was bigger stuff, there's like a ton of media articles about me and what I was doing in Africa and things like that. You may not know this, but it was because of all these articles that were out. I had then a friend who worked at CNBC in Africa. He was the CFO then. So when I went back to Rwanda, he said, "Hey, I read all these things about you. Why don't we have you on CNBC and then, like do all these things that you're doing in Africa? Just do like some story about it." I was like, "Yeah, amazing." And that actually became like the path for me to be a regular guest on CNBC Closing Bell for several years after that, in addition to so many other things that I did. And that was also because of you that I had that widespread media coverage. So a lot of my public profile has been built because of your efforts.
No, I appreciate the kind words, but I must thank you as well, because back in 2016, even I did not have a lot of people who were reaching out to me, asking me to be an advisor. So
that's humble. That's you being humble. You were already somebody at that point in time. You're just being very humble.
I think, you know what, that's also one of the interesting points, right? Like the external world looks at a founder journey so differently than the founder looks at themselves, right?
Yeah.
And especially in the first couple of years, there's so much of this self-doubt that goes on.
Yeah.
So I distinctly remember that I was very pleasantly surprised. And not that, of course, I had built a bit of a company and there was a bit of a success. There was a bit of a product market fit in some sort, right?
Yeah.
So there was some sort of a confidence there for sure. But I think that by any metric, we were not a successful company back then.
That's because probably your definition of success is very different, but you were already successful at that point in time. I also have to add that we had never met for about 3-4 years, after that. Like a lot of my communication with you was on emails and text. I had not even heard your voice until after a few years when you came to New York, and then I met you, and then I met your wife and everybody. But up until then, but I'm so glad, because ever since that first email or first conversation up until now, I have always felt and looked at you as a very dear and a close friend who has always been so candid and upfront and helpful all throughout. I cherish the equation that I share with you, and I'm so excited to do this with you today.
You're being very kind with your words. Thank you.
Amazing. So Dhruvil, I'm going to get into my host mode, and we're going to walk through some of the questions to get to know you up close and personal. Okay?
Absolutely.
You ready for that?
Go
You
on.
ready to reveal a lot of your top secrets?
Shoot.
Yeah. Okay. So I want to start with your childhood. Just tell me a bit about what were you like a child? How were you raised? What was that little Dhruvil like? What did he envision his journey to be? What was that few years, formative years of your life, and how did that shape you as a person that you are today?
Yeah. So as a child, I was the youngest sibling of 3. I have 2 elder sisters, and also my father was the youngest sibling, amongst 5 brothers and sisters, 5 siblings there. So I was literally the youngest person in the whole family, and obviously the only son. And in India back then, and even to an extent now also, but back then, being the only son of the house used to be like you used to kind of just get some privileges, right there. So I think I had a very privileged childhood from a treatment perspective, right? Not that my father was not very wealthy, but he was extremely hardworking. He was traveling a lot, so I've always seen my father kind of on the run, not knowing what we are doing in academics, even which grade we are in, things like that. I remember when I finished my 10th grade, and when the results came out. And I got pretty good results back then. My father was very pleasantly surprised and shocked that how did you really get so much, and turned out that he never paid attention to what I was doing. So I had a very bittersweet moment at that time where I knew that I'm doing well and I'm worthy of something, but I realized that my family does not really have a lot of time for me. At the same time, my mother and my sisters kind of set very good examples for me. So I always used to aspire for excellence. My mother was very much very strict about my education, and she wanted me to do really well, which I did, which I'm very, very thankful for that. My sister also went to Carnegie Mellon. She was the first, one of the very initial students at CMU to appear for the program with a major in machine learning in 2005.
Oh, wow.
When machine learning was a very research topic. And then she, got a job at McKinsey. So she was very, she was very bright, and she was like a role model to me. So I think my childhood kind of was very, very much around I think giving a lot of liberty, a lot of push towards having good education, all the resources I always wanted. over those 20 years of my childhood, my father's business also kind of grew really well. Almost, I think, rough numbers, but grew from almost $1 million in revenue to $100 million in revenue in manufacturing, which is extremely difficult business to run in India. And I always saw him, working hard, as I said, but at the same time, I also saw him negotiating with his dealers. I saw collecting payments from his B2B customers. I saw him expanding his sales territories beyond India and into international markets. I saw him dealing with labor issues. I saw him being very quality conscious in terms of his products, in terms of what goes out to the customer has to be perfect. And a lot of that also used to reflect in his usual behavior at home, where he would want everything to be perfect around him, and things like that, right? And he was a very strict person that way also, because he always had this thing that, he whatever he has given us, we need to respect that.
Yeah.
So I think that's the kind of, a lot of good things that I learned from that behavior as well, where I subconsciously adopted a lot of learnings around entrepreneurship, how businesses are built. I never had the plan to really build a business at that time. And, towards the end of my childhood, right, when I entered the college days, my uncles and my other extended family members in India always used to question me in terms of why am I doing engineering, because I should be pursuing the family business, and kind of, since it's growing so well, you should kind of take it to the next level. And I somehow had this like feeling, because of all these variety of surroundings and situations, I had that rebel kind of a feeling by the time I really entered the college, where I wanted to prove myself. And I think in hindsight now, I know that I always had this desire to prove myself in front of my father, because I wanted to kind of showcase that I'm worthy of something and I can do something on my own. And I think that feeling of mine led me to apply at Carnegie Mellon again to pursue further education in again machine learning. So I did that. I also got a good job. I still remember the first job I got. I sent a message the SMS to my father, saying that I'm finally worth this much. And he was so unhappy looking at the message because it sounded like I'm trying to prove something, that I'm bigger than you. And I think that's what kind of eventually led me to think about entrepreneurship as a career.
Yeah, but that was also going to be my question. You and I have that A.T. Kearney connection in common, because you went to A.T. Kearney, but you didn't pursue that job. I think you were an intern. You never really went there full time, right?
Correct. I did an intern. So I had a project at CMU in third semester, which was sponsored by A.T. Kearney, and that project turned into a job offer, which I never took. And I think at that time, the whole aspiration was, this whole consulting firms also had like layers in my mind. Like there was, the top was obviously McKinsey, and then you can do Deloitte, or you can do EY, and then you can do kind of A.T. Kearney. In hindsight, that would have been a
wait.
great.
It is no.
In my mind,
No. It is McKinsey, like MBBs, Oliver Wyman, A.T. Kearney, then EY and
For
Deloitte.
strategy, yes, you are
strategy,
right.
yes.
Again, this was all the interesting layers I had made in my own mind.
Yeah.
But I think A.T. Kearney was purely, I think they were offering me a supply chain consultant role, by the way.
Because there was supply chain was very big practice of theirs.
I think it's still very
globally.
big. Yeah. I think later on, I remember we had also tried to partner with them back in 2018, 2019, to kind of help us sell more into their network. But yeah, I think I just kind of never clicked in that supply chain consulting mode. Deloitte was offering a good salary, a good exposure to e-commerce consulting as such, which is when I kind of had customers like Walmart, Target, McDonald's, and they were all building their e-commerce strategy at that time. This was 2012, 2013 time frame, when Amazon had just filed their first profitable quarter. Amazon had a flat stock for the whole decade from 2001 to 2010.
I think that was 2014 or 15 when Amazon for the first time had a profitable quarter.
Roughly. And I think at that time, there was a huge wave, because everybody was so, speculative about Amazon's success in different ways. And a lot of people had a negative outlook towards e-commerce, that e-commerce is a bubble, will not probably survive, because ultimately it doesn't make sense to kind of go to every customer's home and give them this free delivery, and the margins will never be there. But when Amazon started making profits, I think the whole shift suddenly changed towards everybody trying to build e-commerce. And that was also the inception of LogiNext, where in 2014-15 time frame, I kind of saw that all these large enterprises, they're trying to do e-commerce, but they're just busy building the strategy, and they don't really have the tech that it takes to execute e-commerce, right? And then they would go to these third-party vendors who would kind of build them a cart, who would build them a catalog, who would build them some SEO online so that they can start selling online. But they would ultimately go to this UPS and FedEx and postal service to do the fulfillment, which would take like 5 days to fulfill. And Amazon, again, being Amazon, launched Amazon Prime at that time, which kind of really attracted the whole, got their whole attention towards them. And nobody wanted to wait for 5 days to get the deliveries anymore. So that's when I had this thought that if I can help customers or help enterprises deliver better, cheaper, and faster with the use of tech, then there could be some market opportunity.
So I want to talk more about the vision that you set for LogiNext. But before that, it was an interesting path that you could have taken. So I am surprised that after Carnegie Mellon, you decided to go back to India, because that's a very Gujarati Indian dream to settle overseas, to come to like top school, top college here, make the top dollar here, right? You obviously didn't choose that path. Okay, I can probably understand. Probably that did not attract you. But if you really wanted to be an entrepreneur, you always had the option to go back to your father and join his business and possibly do something tech innovation there if need be, because that was really on a very good scale,
Yep.
And I'm not talking about like some very small business and then you're like, okay, I'm not interested, this is not fun. This is pretty massive business, and this is a very big number for India.
Yeah.
So if entrepreneurship was really the bug, why not go work with your father?
So first reason was that I did not really have so much of understanding about evaluating even options, right? I was 25 years old, had a lot of energy. I was very hardworking, was doing well at Deloitte, and had this thought that, I see a problem in front of me and I'm working so hard. Why do I end up, why do I, aspire to become a partner at Deloitte instead of actually kind of working for myself and solving this niche problem that I've kind of figured out and I strongly feel for. I've talked to customers who face it day in, day out, and they still haven't figured out the answer to it. And then this whole joining back to family business just never kind of occurred to me. That was one. Also, I wouldn't lie, I was still kind of focusing on US only. So I had, of course, US was definitely
Aspiration.
a very aspirational territory to be in. All my friends who were here, in fact, all the people who did well in college, they all moved to US, right? And all the people who did well in US, they all got these top jobs and they were kind of, making a lot of money, traveling a lot and having a time of their life, right? And being a 25-year-old, that's all you need in life. But at the same time, when I quit the Deloitte, I still remember in October 2014, I sent my resignation email without even thinking that I will not be able to live in US if I quit because I was on H1B.
Yeah.
So the real reason of me moving to India is actually not that I wanted to move to India. Is because I did not have a visa to sponsor myself and I had just quit the job. It was a very short notice period. And on my very first day being unemployed, I realized that I can't be in this country for more than 4 weeks and I have to get another job. And at that time, there was no O1 visa understanding and things like that, right? So I was like, oh my God, this is a problem.
Yeah.
Secondly, I thought having $100,000 in savings is a lot of money to start your business. Turns out that's not enough for you in US, right? Because you have to pay your own bills. Plus, you can't even hire one full-time employee to work for you. You can't just do contracting with multiple people because you have to kind of file the taxes and you have to kind of be compliant with the local laws around that. I found all of that too much to take in. But $100,000 back then, even today actually, for India was a lot of money to
Big
start,
money.
right?
Yeah.
So I
For a
packed the bag.
25-year-old.
For
a 25-year-old, it's a lot of money.
I think for a software business, I think recently there was this podcast between Nikhil Kamath and Mr. Kumar Mangalam Birla.
Yeah, I saw.
Where they were discussing that 1 crore.
How much is enough to
how much
start
to
a business?
right?
Yeah.
And that actually
and
became where.
he had a very privileged answer. I'm sorry. He's like, oh
Yes.
no, 1 crore. What are you going to do?
I usually don't disagree with a lot of successful business people, but that's one line definitely I disagree with, because even today, with 1 crore of capital, you can you can kick off a business. You have a 6 to 12 month runway.
Yeah.
You can get a couple of developers to kind of work and build your product. Again, this is possible more for software or tech kind of business.
No, but I'll tell you what. Part of reason I agree, but I also agree with your point. Part of the reason I agree with him is because what is happening today in today's market, our understanding of runway can change very quickly in 6 months' time. That market is so dynamic that when you start off thinking that, 100,000 is enough, 3 months' time you realize no, because you have to probably build something which is very proprietary tech or like out of the box, and you have to also invest a lot to be like deep in the operation sense of it. I think market today is a lot more competitive.
I think that's also also the difference between the US ecosystem and the India ecosystem, right? And lately, I think literally this week, there has been some tweet threads going on this one, right? Where US ecosystem is largely focused on creating truly innovative companies where you need to invest a lot to create a truly path-breaking product.
Yes.
Truly innovative stuff. You can't just like solve an incremental problem and then kind of, be in the market. On contrary, why India does not see truly path-breaking innovation is because there's so much broken at the ground level, which are immediate market opportunities. And most of the personal capital or venture capital is invested towards solving such problems, which at a global level, they don't really look like big innovation, but for India, they are pretty big problems to solve. And I think that's why, again, coming back to for India, and like being in India and solving a problem for India, I feel 1 crore is enough.
Yeah. But at that point in time, the exchange rate possibly when you went was like what, 56, 57
Of course,
rupees. So you felt like
65,
even with
I remember.
60, yeah. So you said that was like safe enough for you to go back and try. And
So we had like 12 months of runway.
So you bootstrapped.
We bootstrapped, yes. I started towards the end of 2014. About 7 months in the journey, I realized that I have spent most of the money I had, because we got like 3 contractors, and we were paying them about like $10,000 for a 3-month project. I would call them like pretty low cost from that perspective. Not the best quality also, I would say. But they were, of course, believers. They were happy to join the bandwagon and get us off the ground. And the 7th month, when I realized that this is not going to last a lot, and I need to kind of wake up. And obviously, there was no product built at that time which I could have taken to market. There was no customers. There was no revenue whatsoever. But at that time, I joined this incubator by Microsoft and Reliance in India, and I think they helped a lot. They kind of coached me to to be able to pitch to angel investors, seed investors. I made about 10 pitches in India, raised our first round at $500,000 at about $1.5 million of pre-money. Now it's pretty low, because these days, the lowest initial valuation is like $3 million, like the lowest. I've rarely seen founders raising their first round below $3 million.
Oh, wow.
Like even the youngest, the newest on the on the street founder would not go below that. But at that time, like $500,000, $1 million was the benchmark in terms of like raising your first round. So I diluted about 20% equity, and give out 2 board seats, and raise the first round. And I think that kind of helped me extend the runway by another 12 to 18 months.
Yeah. And so what was the vision for LogiNext in early days? What were you what was that first problem that you're trying to solve? And just want to get into the early stage journey, what was your vision early on? What was the big problem that you were trying to solve? And how much has your vision evolved, or that problem deviated from the original problem that you were solving for?
Yeah. I think the initial problem that we're trying to solve was that the visibility in supply chain or transportation, right? Which is basically in layman term, knowing where your package is.
By the way, before that, explain to me what LogiNext does in like a few sentences, and then we get, because maybe many our viewers might not even know what you do.
So LogiNext is an enterprise software for companies that are trying to start doing home deliveries. So let's say if you have a business of mid-size or large size, but you are largely offline. Or you have some online presence and you're doing a 3-day, 5-day shipping of, let's say, furnitures, of let's say apparels, let's say of perfumes, could be any category of goods.
Not UPS and FedEx, but any other business who wants to sell their own product, maybe to other enterprise or to the consumers.
Correct.
Correct,
exactly. And then if you, and we call them shipper in our language. UPS and a FedEx would be called a carrier in our language, right? So we work with shippers more than the carriers. And the shippers typically struggle to find these multiple carriers, negotiate rates with them, and also find local carriers which are usually faster and cheaper than the UPSs and FedExes of the world. So we have a whole marketplace of multiple carriers which these shippers can ship through. So they have to basically push their orders. When you actually, when let's say as an end consumer, when you go to a shipper's website or a brand's website, and when you go to the checkout page, you get that ETA that is going to be delivered today or tomorrow or in this time window or at this hour. That gets computed by us. So at that time, your data or your basic information gets pushed to our software via API, and we tell that website or that brand owner on what to tell the end customer on when they can expect to receive that shipment.
So it's on the analytics side of things.
We don't call it because analytics is largely about like the post processing.
Yeah,
of the
it's
orders.
also the revenue analytics and
So
all
we,
of that.
so we largely call it dispatch operations and dispatch optimization.
Yeah.
Right? So like,
do you match the brand with the shipper, or you don't? So they have to find their own shippers on
Carriers.
Carriers.
Yeah, so
they have to find their own.
That's why I don't use the shipper kind of language. It's a little confusing. That's more industry lingo. But a brand doesn't have to find their own carriers. They can just pick one of the listed carriers on our platform, or if they have other carriers they're working with, they can also list them on our platform. So they get to see our 10 options and they also get to see their 2 options. And then there's this allocation engine which automatically picks the best carrier so that the end consumer who is purchasing online doesn't have to really care about picking and figuring out what's going to happen behind the scene. Like as an end consumer, you get a very seamless experience of just clicking a button and then getting the delivery when you are promised.
Yeah. Does that overlap with anything that Uber Freight does?
Uber Freight would do the exact same thing for intercity shipment. We do that for last mile.
Okay, got it. But you're there.
We are there. And Uber Freight obviously, so what Uber Freight did is that they added a discounted carrier level also on top of it. So what they would do, they would just not pick the best carrier, they would also discount it by 10% for their customer, which is for the brands. And naturally, it would just make it super, super easy for brands to work with Uber Freight because now somebody's paying for a big discount, right?
Yeah, it's largely, I think, to onboard new customers and get the loyalty built from that perspective.
So in our business, I think it's like if you can burn more money, you can acquire customers super, super fast. But the problem is that customers don't have any loyalty. So if you stop burning money, customers will go to somebody else who's burning money.
Yeah, the switching cost is very low for them.
Very low.
Yeah. Okay, so this is what you were planning to do. And what was your vision for this? Like, this was the problem this is the business that you wanted to build. This is probably the problem that you wanted to solve. Give them optimization in terms of like finding the right partner for them, optimizing their cost, optimizing their time, giving them a lot of visibility on what that delivery time will look like. What was your early on vision? Like what you wanted this company to do, and how has that changed now?
So that was the second part of your question, right? I would say I've been one of those fortunate ones where we have not pivoted a lot. So we have never had any significant pivot.
Amazing.
We practically, first of all, we do everything that we set out to do. Just that we have enhanced the idea a lot. Now we do a lot more. For example, now we also help customers build their own fleet of drivers. So we work with McDonald's in more than 100 countries. Now McDonald's does not really have there's no carriers for food, right? There's no UPS for food. You need to have your own drivers, right? As in, like, for example, Uber Eats also has their own drivers, or Grubhub have their own drivers. But what about a McDonald's who doesn't want to work with Uber or Grubhub, right? So we help them build their own fleet. So on our platform, they recruit drivers and the orders get automatically assigned to drivers in real time. And then this whole 30-minute or 20-minute delivery happens. So quick commerce, which is a big thing in India and a lot of parts of Asia. It also got experimented in US a couple of years ago, but did not really work out very well. But I feel that's going to come back to US very soon. That's one of my predictions for US as a market. So quick commerce is something that we can completely power because quick commerce requires extremely fast deliveries and a real-time fleet on the ground which can pick up and deliver on the go in real time. And all that happens on our platform.
So that's an expansion of your original value aspect.
And now we also kind of pay drivers and carriers from our platform. We also do account receivables reconciliation. We have a whole comprehensive reporting portal. And we also have like a driver hiring platform, which is a separate product altogether. It's called Driver Hire. And we don't have a lot of press around it. So we don't, like, only industry people know about it. So yeah, I think we had we had only 20% of what we do right now thought through when we started. So we do almost like 5 times more amount of stuff.
Yeah.
And I think we have built this over these last 10 years.
You've kind of worked on the not early, but a very popular belief of starting a founder, saying like, go narrow on one problem, solve that perfectly, and then you expand into other areas. And that's exactly what LogiNext has done.
Yes. And see, it's not that we had the clarity from day one, right? So we have also learned from our mistakes. Now, in 2016, we also, at that time, we thought that, hey, if we are helping brands find all these carriers or delivery companies, why don't we also deliver for them, for ourselves, for them?
Yeah.
And just kind of, and we had raised our Series A, fresh at that time, and our seed and Series had only like 1 year of gap. So we were so excited, so pumped up, and I was like, raising money is like, it's a child's play. Everybody comes and just gives money. So
those
easy,
are also
right?
the most wonderful years to raise fund, no?
That was also very
2016
was like a pretty peak time, right? Like especially more for India, because that was just the startup ecosystem was beginning to build up. But anyway, so we had raised this money, and we were like, the board is so helpful, investors are friendly, so why don't we just go and acquire a company? So we acquired a company called Your Guy, which used to be in the business of delivering themselves, right? And we realized that was the biggest mistake that we did, right? Because in the first few years, at least, the company must focus on doing less and perfecting it and creating their brand in front of their customers in that niche.
Yeah.
It could be like super simple. Again, the whole MVP concept is very known. Focus, always focus on one thing before you do more. It's also a very known concept, very cliche things to say. But 99% of the founders are not good at it. I would say close to 100% of the founders are not good at it. I was not good at it, right? And I think you only learn that lessons the hard way. We lost, we lost almost 30% of our funding money on that one bad acquisition, which did not even last for 6 months. And we had to shut the whole thing down and come back to our basics. At that time, it was such a bad time. It was beginning of 2017. I was almost borderline depressed because I thought I was on such a high of consistently winning for last 2 years ever since I started, and I had never seen how it feels to really I had never seen how it feels to I never felt how it is to lose something or something for not to work out as you planned, and also at the same time, at that time, we had a lot of attrition in the company because a lot of employees lost faith, that they felt that this is company's directionless. Maybe Dhruvil does not know what he's doing, or these guys now, spent, almost half their money in last just 6 months. So how will they last, another few years by the time they really build revenue, build profits and whatnot? Investors obviously also lost faith because they feel that, I trusted you to give, with this money, and then you kind of just like, went and did, pretty stupid mistakes. So when the whole momentum kind of goes down, felt very depressed. But at that time, I think a lot of other founders, friends were very helpful, right? So the beautiful part, that I'm very grateful about in India is that the founder community is very, very tight.
Yeah.
Unlike the US, where of course founders are very, the great founder friends I have in US, but India has these communities where people kind of just come and talk about the problems, right? And I joined one of the similar communities and I realized that, everybody has
Same problems,
something wrong going on, and I felt just better about myself, and that gave me confidence. And also I met a lot of other SaaS founders, AI founders who are doing very early work, and I realized that they are so focused on building business, going to market, selling, and I think that gave me a reality check that that's how a business is built. The business is not built by raising money and acquiring companies and high flying. The business is built by actually getting customers that want to use a product again.
Yeah. But that's there's a glamour quotient to fundraising. When you're starting off, when you're young, I think that's where you feel the most success because you feel that's the only validation. There's a customer, the uptick in your revenue is the first validation, and the investor confidence in you and the fund you raise these are the proof points in your own mind as a founder. So that's the reason. Like I can understand that the whole euphoria of fundraising and closing, that's probably the highest high, because otherwise every day it's up and down, up and down, up and down, up and down. So that is like the high that you live for sometimes. And you were also very young. I think how many rounds of funding have you raised, and what's the total amount of funding that you raised so far?
We have raised 4 rounds total. and the collective amount is $120 million, but about 30% of that is secondary. That means some of our investors also, sold
Exited,
some of
yeah.
their shares. I also sold some of my shares at
Yeah.
different points in time. And the remaining was primary capital, which came in the company.
Yeah. And approximately what would be the valuation of LogiNext today? I know you have a unicorn
Roughly.
status, so we
No,
can
we are
just-
not a unicorn.
You're not a
Yeah,
unicorn,
I saw
but you
that in
lauded
the
as a
notes, and
unicorn in
no,
a
we
lot
are,
of places.
no, that's another interesting word now. It's called Sunicorn.
Unicorn.
So we are a Sunicorn. I mean, startup world has a lot of words. Like for everything has a word to it. So we are a Sunicorn, which basically means that our valuation is approaching $1 billion.
$1 billion. Okay. So that means you're no longer a startup.
See, I'll tell
It's
you.
a scale-up now.
We stopped using the word startup for ourselves about 5 years ago, and primary reason was to bring maturity in ourselves. Like we often used to, like about roughly in 2019, we had good enterprise customer base, right? We had a good solid product that was selling. We had customers like UPS, McDonald's already in very early stage of the journey with us, but they already were our customers. But our people were still very startup-y. People who would apply at LogiNext were the people who loved to wear multiple hats, who wanted to come and experiment, who wanted to kind of do hackathons and build codes, fail fast. And in the enterprise software space, you can't do all of that, right? Because you have customers who are really running hundreds of millions of dollars worth of deliveries on the platform, and you can't just push code in production because some young engineer felt that this would be a cool feature everybody can use, right? Like you need to really have a proven strategy and methodology towards doing that. So we had a lot of such people. Like even our salespeople were very young. So when we go and talk to CXOs, we were not able to give that matured feeling and we were not able to build credibility at scale. So we wanted to kind of come out of that zone of being called a startup in our own mind. And then we had this initiative in the company where anybody would be penalized if they call ourselves startup. Right?
So what would you call yourself?
Company.
A company.
That's organization. Company.
An organization. Okay. But so when I use the word startup scale up, I say more in terms of the stages. At one point in time, as a startup, it is all about proving yourself, the product market fit, and like you said, identifying the right problem, but solving for it, getting customers. When you cross a certain threshold of funding, then in addition to solving for the problem and generating revenue, many other things kind of take over. One of which would be like the subsequent round of funding, the culture that we're building, the talent that we bring on board, the strategies that we have to retain them, the work-life balance that we want to bring to the picture. And suddenly this company is a lot more in limelight. So whatever we do or whatever you do is now under a lot of media scrutiny, under a lot of worldly scrutiny. So suddenly it is not just about product market fit, revenue and all of this. There are like other variables coming in, and somewhere they hold a lot of importance. You kind of start equating all of that in parallel to your other core aspects, which you have, like the fundamentals that you have to work on if you're a company or a startup, right? So that's a scale-up journey for me. And since you're no longer a startup, in my terminology, this company that you built, I'm going to talk about your scale-up journey, okay? I want to start with funding. Raising series, pre-series, or pre-series, seed, Series A, up until then, I think it is very easy because you're talking about a couple of $1 million to about tens of millions of dollars. Fundraising beyond that gets extremely challenging because it is not just about your traction anymore. It is not about just the problem that you're trying to solve. It's about what is the very unique fundamental problem that you're solving and how is this going to be the next Sunicorn, unicorn, or whatever you want to call it, right? And that is the hardest because now the history with all its ups and downs is going to speak about fundraising. And the fundraising, yes, there were glory years before the whole interest rate kind of took off. But even then, it was extremely challenging. I remember one of our conversations around fundraising. And you said, Anu, I was fundraising for 9 months unsuccessfully. And you said at one point in time, you were in front of one of your investors and you cried. You cried at how you were just not able to crack it, I want to talk about that challenge of a scale up.
So I think you're so right that usually in the seed round, the only thing that investors look for is how reliable, credible the founder is. How good of a how high are you on the integrity? What's your background like? Are you able to think big? Are you excited about it? Right, things like that.
And also, like, you know, the TAM, SAM, SOMs of the world.
Still not
Like,
too much.
very-
Honestly, I've seen
yeah.
like at seed level, it's not a lot of like TAM, SAM. That's more on the Series A. So I think Series A is when you kind of get this like market size calculation to be. You know, I think all the seed decks I've seen has some market size number, but it's often like way too off. And even the product, the market, the vision is still like just being figured out. So nobody really cares too much on it. There has to be general sense that it looks like a big market. Then in Series A, you kind of do this all, variety of calculations. Some sort of like what's your traction kind of gets considered. But it's still not entirely number driven. It's still more about storytelling, like were you able to get the initial customers, initial team members in place. So if you are able to build some sort of a momentum, Series A will still kind of, you'll be able to land Series A as a sensible founder. I think suddenly a Series B, right? I think that's when it entirely becomes number driven, right? Your market sizing has to be extremely accurate to an extent where, let's say, for example, if we had a $2 billion market, we needed to know exactly how many companies and which companies exist in this market and how much each company are spending in transportation, where they are in their e-commerce journey, how much they will potentially pay us if they become our customers, right? So we have to have a whole math figured out properly. Our MIS, right, which is the whole financial history of the company, has to be fully accurate. So you need to show a revenue trend in terms of your growth rates, your gross margins has to be solid. Your people cost average has to be good. Your sales efficiency has to be strong. All these metrics have to be in place. And if you don't have any metric, they would kind of question you a lot on that to see how seasoned you are. Like, have you thought through how you will fix that metric, even if you don't have that in place, right? Because often a lot of companies don't have everything figured out, obviously. Then the third thing is, do you have leadership team members? Do you have like VPs working for you? How smart they are? Are they able to participate in board meetings or not? What's your cap table like? Have you diluted too much already before Series B or not? Right? Like, and then, like, what quality of revenue you have? Like, do you have like more US revenue or like mix of like multiple cohorts? Things like that. So there's so many things that have to be, done right. And I did not know about it because I was not coached for it. And our board was fairly hands-off before that. So they were very friendly, which I always used to admire. But I realized that a friendly investor also is sometimes detrimental because you just never get coached, right? You have the freedom to make mistakes and nobody really corrects you.
Yeah, you want a mentor in an advisor.
Absolutely.
Yeah.
It's extremely important. After Series A, you do like up to Series A, you are okay with the freedom because you want to innovate, experiment.
Yeah.
Then slowly you want to have somebody who can start doing it. And I remember in 2019 was pretty much the whole year, the 9 months I spent fundraising. I would have pitched to almost 100 investors, starting from small funds to mid-sized funds to India funds to US funds to SaaS funds to non-SaaS funds. And month over month, I just kept on getting rejected. I also appointed an investment banker, assuming that a banker might help, right? But they just basically exposed me to even more investors. But ultimately, it's the CEO's job to raise money. I remember in almost in the 9 month, I had a couple of term sheets, but I was so broken from inside, and I was so low on confidence. And one of our existing investors, I kind of called, and I just ended up, kind of busting out, and I ended up crying. And I actually ended up venting out on them also, and they were very kind enough to just listen to me at that time.
How old were you then?
I was 30 years old.
You were very young.
Yeah, I was very young, yes.
Yeah.
But I could have had now in hindsight, I feel that I should have been emotionally more.
Actually, I'll disagree with you. The outburst, the venting, the crying. I think what is the world. This is like toxic masculinity because, or even even for women, you just grow up, man up.
Yeah.
I think that's not true. Being vulnerable is strength. You had the ability to like be vulnerable in front of them and tell them like I am failing here.
Yeah.
I haven't gotten through these.
And I think that's what happened because I was just not being vulnerable all that while. So it all kind of built up. But glad that happened because after that, my relationship with that investor became so strong.
Absolutely, yeah.
that I think now we laugh about that moment, and every time I'm feeling low, that person reminds me of that, and it just kind of brings that confidence back in me that like things happen. But anyways, I think I don't know what happened from that point onwards, things went right. And I think I was able to close the round in just like 1 month after that.
You 1 month with Tiger Capital,
Yes.
Steadview,
Tiger Global, Steadview Capital. But both of them are very, I also thank both of them for that, because both of them are very fast in terms of the decision making, right? So I think turned out that my lesson learned, long story short, the lesson learned was I was pitching to the wrong investors. While I was pitching to many, I needed to pitch to the right ones who truly believe in that market. I think that's some sort of a belief that works. And I was working hard towards convincing investors who never believed in this market.
Yeah.
And any number I brought to them was not enough.
So, but this is then the product market fit in the investment side of things. Because after a point in time, you have to identify who are the investors who have either view of that market
Yes.
or space,
Yes.
have invested in similar companies, or they're kind of subject matter experts in those companies,
Yeah.
and then go after that. Because not every investor has a stomach to invest a couple of tens of $1 million or $100 million and lose it. And so that's why they're like very cautious, and they don't have the vision to understand your vision unless they've been in that space, or they've seen similar companies,
Yeah.
or they've been in the network of funds who have invested in similar companies. I think one of the challenges with the scale up capital then is also identifying your niche in that space. Like, who are my investors in that space?
Yeah.
And that sometimes is as demanding and as challenging as finding your niche with your customers. Would you not agree?
100%. This is and I think this is one of the most important things. And every founder should do this analysis at the beginning of their fundraise. Rather than chasing every investor that comes their way, they need to shortlist the investors who typically invest in their space, who typically invest their check size. Let's say if you're raising $10 million, don't go to investors who are writing $100 million check. Right? Most founders think that somebody who writes $100 million check can easily give me $10 million.
But that, I think a lot of funds, but Tiger Capital also is doing a lot of smaller checks,
they
right?
largely failed at it.
Oh, really?
So Tiger has completely stopped in last 18 months,
Okay.
completely stopped writing small checks.
That's not their expertise anyways. And
Not
also
their
the kind of return that they're looking at.
It doesn't move the needle for them.
Yeah.
Right? Like, let's say if you're raising, most of the Tiger's funds are between $2 billion to $7 billion, right? And they raise funds every 2 years.
Yeah.
Now imagine having like at least $2 billion more, and you ultimately have like 50 people who can take decisions in the company,
Yeah.
right? So everybody then has to kind of keep making deals. And that's why, if you remember, in 2021, in 1 year, Tiger had done 450 deals in the US, across the world. That basically meant that there was 450, but somewhere around like 350 or something. That practically
one
meant
deal
that
every
one
day.
deal every day, including weekend, is what they were
Including
saying.
weekend,
Yes.
yeah.
And I think that's just and that did not really work out for them. So they had to write off a lot of their portfolio companies. I remember I also know founders who have taken $1 million from Tiger. And Tiger has like no bandwidth right now to
manage that.
It's
It's also when you do smaller check sizes, your gestation period is also higher. If you're raising funds every 2 years, which means that you are also under pressure to show the performance of your last fund.
Exactly.
And so you're hoping at least some of your assets you'll be able to have exits with.
and a $1 million company even
No.
grows 100x.
Doesn't
it still
matter.
doesn't return your fund.
Yeah,
right? So-
exactly. So it's fair point. So basically then that is the key learning on a scale-up stage when you
And-
go from Series A to B.
Correct. And another thing is that I think getting your numbers right. I think no matter what, like no matter how good you might be with storytelling, how good you might be at creating excitement, or how much the investor is already convinced on the market, you need to have your metrics in place. I think
Very
that
important.
was and I think most founders in that journey only kind of realize that. And because the investor kind of teach you that you need to kind of become a mature. I remember one of the investors asked me in that Series B fundraising, and the feedback, not asked me, but the feedback they shared on why they could not invest in me was that I am not a CEO they see that can be a public CEO. And I still remember that sentence, and I took it like very, very to my heart. And
Personally, right?
yeah.
It's like, I'll show you.
Because the reason was me, and there's usually the reason is never me in terms of why you did not invest, right?
I cannot be the reason.
Yeah. So, but they were so right. I was not, I was not exhibiting the traits.
What would those traits be?
And the traits basically is how compliant the business is to local regulations, global regulations.
It's not required at that stage, no?
But you need to even at least know about it. You may not be fully compliant, but if you don't even know about it, it's like it shows severe level of underprepared. I think this compliance is one topic which most founders don't talk about in the world.
Oh.
But they all go through this journey, and I think it's a very under-talked and underrated topic, I feel. But yeah, maybe for some other time.
So, but compliance was one reason. They thought you're not a public company CEO. What else?
Another thing was, I think compliance was the one. And another thing was that our sales motion was not repeatable. That means that as a public company, you need to start thinking about being able to predict your next quarter and also hit it. So we had like a lot of quarters where we would do like amazingly well, and a lot of quarters we would underperform. Net at a year level, we would do really well. But that's not what public markets want.
But then how old was your company at that point in time?
5 years.
5 years. So that's still also relatively new. Because even...
But see, these are some of these investors, they have seen in their portfolio where companies go public within less than 10 years. So if you haven't really started getting some sort of sales efficiency, sales predictability in your engine, it kind of, they don't see a roadmap to go public in next 5 years.
But do you agree with that? Because that is something one can fix. You can fix it like that.
Correct.
So this is coachable. This is not a trait or this is not a problem which is not fixable.
I think they were also, in hindsight, and I don't know about that, but I feel that they were also in there towards the end of their fund cycle, where they were also impatient. They wanted to invest into companies where the CEO is public ready, so that you could do public in 3 to 5 years and you could return the capital, sooner than later.
Yeah.
Let's say the funds you talk to, if they're early in their fund cycle, then their patience levels are much higher.
So I think it's a lot about understanding who your target audience is, understanding their timing. So to some extent, it's like job hunt and job search, where are the macro trends, where are the economic trends, and what the corporate is looking for, what your hiring manager is looking for, where is he in his journey.
And that's why if you see, asking questions to your investors is equally important.
Yeah.
Most founders, even the smartest ones, don't ask good questions to investors. I never used to ask good questions in my first 5 years of journey to investors.
What are the top 5 good questions you will ask today?
The number one question I ask now is, what's your IRR of the company? Right? What's the returns looking like at the fund level? Number 2 is where you are in your fund cycle. Usually it's publicly available because whenever these guys raise money, they announce, so you can kind of predict in terms of where they are. Third is, what are their LPs expecting in terms of returns, right? Not every fund has the same return expectations. Some funds are very happy with 15% returns, but they want to preserve their capital and not take too many risks. And some funds, for example, like Tiger or A16Z, they want to go for the moonshots, right? They want to have more than 30% returns at a fund level, and for that they take significant risks. Why? Because their investors support taking significant risks, right? They're okay to lose capital if required, so long as in the best case they get 30-35% compounding over a 10-year period. Another question is, how hands-on they truly are. Like, do they really have an operations team? A lot of investors that say that they were very hands-on, we would help you, but they have no team to do it, right?
They don't,
and there's no chance they will do it, right? So that's another thing to ask. Yeah, things like that.
Yeah. So that's a very important aspect of scale up. Challenging. You've obviously successfully closed that round. Now I come to the second challenge of a scale up, which is building that team, building that culture, preserving the talent. Okay. Walk me through some of the early challenges. And actually, let me frame it this way. So what happens is, in the early few years of a startup, the expectation is, and also a lot of talent that you get, because those are the days where you are all over the place, where everyone's burning the midnight oil, everyone is trying to find a solution, and everyone's excited to do that. It's hands-on, it's scrappy. Generally, startups see that there's a lot of interest from youngsters, fresh grad, who have aspiration of wanting to prove themselves. Yeah. A lot of people want to work in startup because they want to get the tag of startup so that they can go work in a big tech later, because startup experience is very valuable. It's like a school in itself.
I didn't know that.
Yeah. At least in United States, the startup experience is very, very valued. Like, even if you failed as a founder, you've worked with a failed startup, even if you've been a janitor at a startup, you have to have a startup on your resume, especially in big tech.
That's good.
So a lot of people go with that, that whole hunger to work in a startup, but they burn out very quickly in the first few years.
They do.
They've had decent equity. They're the early employees. They get out. And, then they go on with their life and they have a lot of complaints that work-life balance is not good. Like you said, direction is not good, risk is high, so on and so forth. And that's okay. Startups, go through that. Investors are okay. Minute you scale up, now everything changes. Now everything is under ultra high scrutiny because there is a build up to that time, which a founder has also done. He has built his own equity through a lot of media presence, through a lot of public presence. There's a lot of things about startup that is out, in media, and there's a whole public angle to it. And now you also raised now a couple of $100 million. So there's like a higher profile of a startup, of a founder. And to scale up, you need that sustenance of the talent flow. What would be few of the what were some of your challenges at that point in time? So walk me through what was the culture before that Series B. What happened to the culture after that? What were some of your learnings in that process?
One of the biggest thing that we always were very infamous for was working 6 days every week. So until that Series B or until 2020, which is when we also pandemic was very helpful to our business because more businesses started going, doing home deliveries after that and stuff like that. But the biggest drawback of our culture at that time, that it was very hardworking culture. Now we used to admire it. I used to love it. I was like always, kind of yelling in front of everybody that, we must work hard. And there's nothing called as work-life balance, right?
Oh my God! Unpopular opinion. You don't believe in work-life balance.
I still don't. I'm still very vocal about it in front of my team also. And a lot of times my team also gets to see all these podcasts where I kind of go and publicly talk about I don't care about work-life balance. On a podcast I said work-life balance is for the weak. And I'm actually pretty okay with that because I feel so. Here's what I strongly feel: in a culture, as an organization, you don't really build your business model around the culture of the company. You build the culture around the business model of the company. And it's very difficult concept for people to understand because it's a very anti-people. It sounds very anti-people.
But it is also very shareholder value creation concept. It's a very capitalist concept because you see in United States, that's pretty much how it is. Amazon has its own culture. Meta has its own culture. Exactly. Google has its own culture.
And if you see all of them, except for I think Google, barring Google, most of this big tech, like even these days rippling kind of companies, right? Like they're all doing about $500 million in ARR and whatnot. They're all, notorious about notorious famous about work from office is great, definitely one good point, but also being just very toxic or very very aggressive at work, or my boss is expecting me to kind of respond to email at 8 p.m. right, things like that, right? But I think if you see an underlying pattern behind most of the successful companies, I'm not saying that's the only way to become successful, but a large majority of successful companies have had a very long period of extensive hard work put in by pretty much most of the employees, not just the founders.
Or it is monopolistic business who like Google, you just grow and grow and grow and grow and grow. Correct. Right? Yeah. There's no competition for you. So there they have a company culture. It's very relaxed. You come, you go, you stay. You want to stay, don't stay.
Right.
I have friends at Google early on, before this is pre-pandemic. They'll say, we'll go to office at 10 in the morning. Get out at 2 p.m. and they're on the golf course in Mountain View. I was like, that's the life,
I still hear that. It's very, I think it's even till date. I don't know. Like I have a bunch of friends. I'm not really, kept in touch with many, but I think that's a very common thing for Google right now also. And I think even for Amazon right till date, it still kind of exhibits general aggressiveness culture, right? Probably you would know more because you worked for big tech.
How can I say that on the record? Sure.
You should. I think this is like this. I always encourage.
I
all
still have a job. I'm sorry.
Yeah. So I think I strongly feel that ultimately founders are always going to take, or the top founders will always, or top entrepreneurs will always take the call in favor of the shareholders of the company. And that's why if you are working for a startup, you must own equity. You must have stock options. If you're working for a startup without stock options, then probably then I think it's rightful to have that feeling that you are overworked without really getting anywhere in your life. One should join startups only if they are very clear that they also want to be a part of wealth creation, right? That's their shot to create wealth. not necessarily that they will, because again, 99 out of 100 startups are not gonna go anywhere in terms of wealth creation. Many companies also grow, but their value does not grow. Their stock does not liquidate. So it never turns into cash. Things like that. So there are so many constraints before you really make a lot of money. But if you're joining startups, I think that's the fundamental reason for it. Yes, in the first few months or even during your job, you don't always think about making money when you're working at a startup job. You just don't think every day that, oh, I'm here only for money.
Yeah.
but I mean, if you're joining not for money, but just to kind of, wear multiple hats and have some fun, very quickly that fun will fade out. And the reality will kick in, which will be a lot of work, prolonged hours for years and years of your tenure.
So this is very interesting. You spoke about equity. Okay, there are a couple of things you mentioned early on that you liquidated your stake over a period of Series A and B.
Very little of it.
Very little of it. So you obviously made cash in those years, right? So what happens with employees is they don't have an exit option. Not in Series A, not in Series B. So you had your first engineer join with you on day one, let's assume, right? You liquidating your stocks, they don't, because they have ESOPs and they have to wait till you actually go public, right?
Yeah.
That is when what happens is in the year 2, 3, they're like, dude, or 4, because I've vested my equity, I've burnt out, and there's no cash here right now. Let me get out and do something which is a cash-rich job, right? And work-life balance does not exist. For whatever reason, the culture, the philosophy of the founder, just the function of the business, it doesn't exist.
Correct.
What can you do to incentivize this employee to stay longer with you?
So there are definitely two things. So this is a very easy answer, and most companies exercise that. Is that there is a refresher equity grant that you get.
Fine,
right?
but that's just paper money.
And number 2 is the buyback. Right, so many companies also offer buyback now, and the third interesting thing actually, I must talk about that, is that there are now stock exchanges to trade stock options or stocks, which are exercised options within the employees or with
like the secondary market. I think Carta was a platform that used to do that.
Carta never allowed the trading of it, and that's why I think they were sued or something. There was a big problem with Carta lately. I don't know if you should check it out. Carta has been in a bad press for I think somebody internally did trading of stocks looking at Carta's data. There's some public information like that. And that's why a lot of we also were on Carta, we moved out from Carta. And then SEC had sent them a notice and blah, 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 whatever. But anyways, coming to the essence of it, there are secondary markets, there are startups for it. I am missing out on the name of the startup. But also NASDAQ has something called as NASDAQ Private Markets, NPM. That also allows one to trade equity. Now, currently they have the problem with NASDAQ Private Market is that they have a minimum of 100K as a check size in terms of you can only trade worth of $100,000 minimum. Now, many of the employees may not have that much of stocks.
But
exercise.
do they need these employees? Do they need permission from the founder or the company?
Most of the companies don't have a board consent required before you trade. But you need to inform the company for sure. Of course, company has to know that now somebody else owns their stock.
And what about the price point of that stock?
Up to you. Anything.
But so that's the price I decide for myself.
You decide and the buyer decide. Anything is fine.
Oh, so it can be less or more than what the last valuation was at.
Could be absolutely anything. So long as you can convince the buyer, right? Because that's the tough part, right? If it's if the last round is the only publicly known valuation, why would the buyer pay you double?
Yeah,
right?
of
So
course.
you have to do that selling job.
Unless it's a hot startup, pre-IPO for Reddit, I would have bought.
Sure. I mean, again, so
Yes,
so
it
long as
depends.
you can find it.
Yeah.
If you can find, usually it doesn't happen. It's very hard because any retail investor who doesn't know you would find it very difficult to kind of give you a 2x premium, right? Because they know that you're going to make so much money from them.
Yeah.
So it's purely a marketplace eventually, right? That it's about demand, supply, buyer, seller, whatnot. But yeah, that's an option now. That's the third option for employees to kind of get some liquidity.
Yeah.
Also, I feel what my recommendation and suggestion to all the startup professionals and startup team members is that do not join the startup to make money in 4 to 5 years. Almost all of private investments, right? Be it angel investments, employee stock options, private equity, VC, hedge funds in private markets, all of them have an average 8 to 9 years of lockup of their equity. None of the investors who actually put in their millions of dollars of capital
They also don't get it.
They also don't get it. So you as an employee expecting that you will join and then in 4 years you will liquidate your stocks is a very unreasonable expectations from yourself and from the company. Not going to happen. And then you will only set yourself up for failure in your own mind, right? While you will still own the stock, it will come out to be liquid at some point. You will just feel stressed about it for no reason. So I think my recommendation is that take a 10-year horizon. If required, work for 2 companies, right? Like 5 years each. So you get to see the whole working cycle also. You have enough information about the company when you exit, whether the company is going to do well or not. Because if you want to exercise, you'll have to kind of pay that money to the company first, right? So you need to invest also. In countries like India, when you exercise the stocks, you also need to pay tax to the government, right? So it becomes very expensive activity to do. So I think, but you can do it in like just 2 rounds over a 10-year of your career. And then you also have like work for 2 companies. So if at least you have, if one doesn't work out, you know that you are not completely losing out on the whole thing.
Yeah.
But I think working for a startup for 4 or 5 years and then getting impatient and then going back to corporates will most likely result into you putting all your eggs in the same basket first of all. And then also feeling cheated that nothing happened with this.
So RSUs is obviously one incentive. Anything else?
But many private companies don't offer RSUs.
Many don't, actually, that is true. So then they will not. And so then what will be the strategy to retain your top talent?
I think we do it that way only. We give refresher stocks and we have done partial buybacks.
So you're giving them a small exit so that they're also happy.
See, one thing is a fact of life that before IPO or before M&A, no sane buyer is going to buy all your employee equity while you are an employee. Guess why? Because then you lose your motivation. You made your money, you go home, you quit the job, right? So nobody's going to do that. So in best case, you will only be able to sell like 1/4 of your equity.
Which is still a big amount.
Which is still good, yeah. But trust me, most people don't know about it. Most employees, even at LogiNext, a lot of people come and say, oh, it's been 4 years, can I now sell it? So whole of it. I'm like, even if I could buy whole of it, why would I buy whole of it?
I don't have any incentive to.
Why do I take away all your motivation in one go? I will not.
Yeah. So, okay. So that's one way to look at it. Another element now I want to, of the scale up. Firstly, one of the things when I used to be a founder, that a lot of people will say like, oh my God, but it seems like you're quoting media. And I have to explain them that sometimes media and being out there in a public is a necessary evil. Why don't you deep dive on that and tell me your view on this? What is this whole sense of branding or PR around you and your company, and how this is pivotal to your startup and a scale-up journey?
I think I strongly believe in being out there as a business, right? If you don't talk about your business, who else would?
Yeah.
Right? And media is the best platform where you can get free marketing, right? Like especially in the beginning, if you are a smart founder, if you have good pedigree, if you have good storytelling skills, it's relatively easy to attract journalists in the first 2 to 4 years of your journey and get your story out. The best part about media is that the world sees you, right? And you never know what kind of partners you attract, what kind of leads you get. Sometimes it opens up the market channels which you even may not have planned for. You didn't even know those channels exist. But now the people read about you in some newspaper, some magazine, some online portal, and they reached out to you. So I think long story short, like doing PR, doing press about your company is extremely important. In the first, now the pros and cons of it, like the downside of it. In the first couple,
But that's for the first few years. The downside is what I want to introduce. I think what happens after a few years, that's like an uptick. Again, upscale, everything's going great, everything is amazing. Then you are now big because you're Series B startup, you've been out there. Then starts the bad press. That's the downside of it, right? I think you have experienced it. There was most recently, I think sometime last year, there was an article about LogiNext in ET and said like how LogiNext is liquidating its assets in US, possibly exiting US market. And LogiNext is also laying off people, cancelled stock options. And I know you took it in stride because you wrote this funny post where you said, oh my God, I've had my own Heidelberg report moment.
You did it. That's funny.
Right? So, but that's more fun on the face of it. I think there is some sensitivity to this lot of negative press that you also hear about you, about the company. Let's talk about that.
See, so I think when it comes to press, in the beginning you feel very good when you have the first couple of articles about yourself because the biggest thing that makes you feel good is all your friends and family reach out to you.
Yeah.
And they start to feel that you are somebody now.
The validation.
The validation kicks in. Your team members feel that, okay, now we are working for a company which has some online presence in mass market, right? Of course, your customers will always know about you, but that's a very limited set in the world. So it gives you a high. By repeatedly doing it, you get that high a lot. But at the same time, in that journey also, most founders go through this like smaller dips in terms of being misquoted somewhere. So we have had like several instances where I would have been misunderstood, misquoted, misrepresented sometimes also. Sometimes,
Deliberately.
Unfortunately, the world of media is not really, as much as we would like to believe that journalists do a great job, most of them, they want to kind of write about something which gets them eyeballs and clicks versus what the reality is, right? So that happens. So I think by the time you really become big in that, media affairs, you've had your smaller ups and downs to become immune to it. At the same time, you also, the newer press beyond 4 or 5 years of, building a business, that press is not a sustainable way to do marketing. And at the same time, you don't feel the highs and lows when press talks about you because you've seen that enough, right? It's not exciting anymore. Same applies to your management team members also, because sometimes they are also quoted or they're not quoted or misquoted, and they also know the art of doing it. A lot of times press is paid as well, right? So people from internet, they see that, while this article was so good, they knew it was paid. So you don't feel that good when you actually paid for it. But anyway, so I think all that story kind of gets you to a point where you are, you develop that thick skin. And then beyond thick skin, there's this phase comes where you actually end up just joking about it. You're absolutely indifferent to it. You also start attracting that founder circle where there are a lot of these famous people, and you get to know their perspective, and you learn from them that they absolutely care the least. In fact, they want to turn around every single opportunity when they are named in media into their favor. So you subconsciously learn that art. And I think that happened to me as well. So when this article came out, I think by that time I was anyways very immune. Like on that day, there was literally like no thought in the mind, no chatter in office, no conversation. I think even my family didn't even see it properly somehow. God knows what, right? So family did not ask any questions. I think it just kind of flies under the radar so beautifully. In fact, to an extent where I posted that tweet, my investors called me that why did you even acknowledge it? Because now you are giving more fuel by talking about it.
I disagree.
Right?
I think it took away that power when there was a humor in that post. I think it took away the power from the media platform, because then you were like, you're laughing it off like this is so funny.
And what happened in that? And you're so right, because the journalists who wrote it, a lot of people, and they of course they tweet also their own articles every day, right? That this is what I'm publishing today. So a lot of other founders and my team members and customers who knew me and they are in the business and they know what's happening every day, they started kind of bashing the journalist. The journalist was fighting with them on Twitter to prove that no, this is right, and you don't know enough, right? And it was just so funny to, and sometimes like also weirdly fulfilling to see that somebody is trying to kind of attack you.
Someone's trying to pull you down deliberately.
But you have built enough brand equity by creating real value.
Or enough credibility and enough relationship equity for people to bat for you.
Correct.
And I think that part it stuck out to me the most, because I think what happened is, and you're right, because when you're in that circle with people, you understand that when you go up, there's so many people who are trying to pull you down. And they do that on a continuous basis, on an everyday basis. And everyone in that circle has gone through it. In degree of variation, everyone has been through it. So they're like, this doesn't matter. Like,
Absolutely.
we know what you're doing, and it's just peril of that.
And all this ultimately reminds that, you are here to create value for your customers and for your team members, and just stay focused on that.
Yeah, that's a great point. We're talking about value creation. I'm going to jump into the value creation aspect of it. Startup founders, they start with this vision that I want to create this vision, this value, this company, this valuation. There's a threshold, or there's like certain, glass ceiling that you hit in terms of your success, in terms of monetary success as well. And not just monetary success, but also in terms of the scale of your startup. And after that, it becomes flat, because it's not that, exponential growth year on year. That's like sustainable growth. And then they think about, what is next for me? what am I doing next as a startup founder? And there are several paths to that. One path is obviously, taking company public. That's one form of value creation or wealth creation, or an M&A. And then it is about, am I like the public facing CEO? Am I still taking it to IPO, and then I'm still the CEO and I'm running it as a public company CEO? Or am I retiring? Or what am I doing? So what is that journey post success for a founder, from wealth and value creation for self, for company, and for shareholders?
I think you go through a cycle. First, in the beginning of your journey, you get excited with innovation, experimenting, creating something new. From that, I think after 3-4 years of doing that, you graduate towards building metrics and revenue and profits in your company, which is largely shareholder value creation or customer value creation. That's what you focus on, and you start assigning numbers to it. And the third comes is you start thinking about what's in it for me, right? Which is when you start thinking about, I've had like 8-10 years of journey, and when will I make money, right, as a founder? Of course, you have, you draw salary, but eventually your real wealth creation is your stocks. For most founders, they don't get an opportunity to kind of sell their even one bit of their share in secondary markets. I've been fortunate that I could get a couple of opportunities. So
you have liquidated in the secondaries.
I have done that twice, and I have done about 1 to 5% of my holdings. And I don't own majority of the company. I own minority of the company. Majority is owned by shareholders. So I'm answerable to that board. But I've been able to do that. At the same time, I've also been able to liquidate some part of employee stocks. So we have had about 15 employees in the history of the company, where they have sold between 20 to 60% of their holdings.
To you or in the secondaries?
I have bought from one only. 14 have sold
the secondaries,
from the secondary, right? So because I never had money to just buy those stocks myself. And I think that's, and I think after that also, the weirdest part about this journey is that after you create a wealth for yourself and for your team members, you go into this very boring state of life, which is where I am right now, I feel, where you're only repeating numbers and trying to recreate that success again and again. And I think that's when the excitement from building a business starts to slow down. Why? Because it's purely a number game. Like for us right now, all I do is to ensure that I get the best people. And I always used to hate recruitment, but I do 70% of my time is recruitment now. And the remaining 30% of the time is kind of making sure that the team does not deviate from what's working. Because it's a working engine. And then you slowly, get that corporate or the bureaucratic feeling in your own company. You also become less relevant in your company because most problems get solved by the time they come to you. And even the problems that come to you, they are of similar nature, just larger in size, in terms of dollar size. So also you know that you will solve them. So there's no stress that you feel. And once you solve them, there's no high that you get out of it. So it's the journey becomes more monotonous. Becomes flat.
Yeah.
Your stress levels reduce, but your excitement level also reduces together with it. And you also, once you liquidate some stock and you make some money, your mind also subconsciously starts to become busy in preserving that money because it's now your money.
Or growing that money.
And growing that money.
Yeah.
And then you do these things like angel investments, you do, you buy some real estate here and there. You also kind of upgrade your lifestyle. And then you are always, reached out by wealth managers and fund managers to invest in their funds or create some portfolio for you and things like that. And then you realize that a lot of these things, somebody wants to, take some donation from you for their foundation. Somebody wants you to do more community work so that you can give back to founders in different parts of the world. And when you do all of that, you realize that, none of that is as fulfilling as it was when you were building and growing your company. It was stressful, it was challenging. So I think that's the last stage. And I don't know about the next stage, but at least,
So that's the hype curve.
That's kind of the
and
hype.
that it's actually a hype curve up until one stage, and then it is like either flat or it starts to
Yeah,
dip
and
down.
even in the hype curve, like in the beginning, you have that, like, that trough where you kind of feel it's, feel like giving up, nothing is working out, then it starts to work out, and then kind of it stabilizes.
Yeah. But there's a very important aspect that you spoke about, which is wealth creation. First is creating value for you, your shareholders, your company, your employees, and then there's wealth creation for your own self, right? We spoke about this. If you remember, this was a few years ago. We were at the 34th Street at the Grace Cafe or Grace Street Cafe or something like that.
With Saurav,
With Saurav, yeah. And then I asked you, like, Dhruvil, what should I do? Should I invest in startups? Should I buy real estate? What should you do? And since then, you have invested in 50 plus startups, in some 50 plus public companies. You've invested in a few funds. You have 10 plus real estate portfolio. Tell me, what has been your value creation thesis? What has been your investment thesis?
I think for me, the number one value creation thesis is that I want to invest into companies which I understand. So pretty much all my portfolio are companies that I can truly understand. Why? Because I've always been more confident when I go deep into something. And fortunately, I get invited to those deals where I understand the business really well. For example, a lot of the startup deals that come to me are through some of the VC funds who I had pitched in the past. They never invested in me, but they became good friends. Now they seek a lot of help in terms of, hey, can you run this tech diligence for me? Can you talk to this founder and tell me what your view is? And I keep doing that pro bono. My benefit is that when
you expand your network.
I expand my network, and if I stumble upon a good founder
You'll
or a
invest.
good company, I invest. And they can't say no because they have been seeking my help.
And this is a good way of deal sourcing.
And that also compounds. You won't believe. Right now, I have such network has grown so much that I get almost like 4 to 5 startup deals every day.
Wow.
In last 3 months, I haven't gotten a chance to really look into it. I have like literally 100 plus mails in my inbox where I've not responded. And now I feel bad because I've always been very approachable, very responsive person. And I also always promise founders that even if I don't invest, I will help you. So, I'm just an email away for you, while I'm just a WhatsApp away for you.
Yeah.
And I'm not able to do that anymore. So one of the other learning also is that once you do a lot of this investments, there's a ceiling or upper cap to how much you can do. Then naturally you need to become that
Family office
kind of a person. And we are now Leap is helping me setting up the family office. So we are kind of moving all of this into our company.
A more formal setup,
More formal setup. Plus my father's business also is kind of, in its own journey where there's nobody who can run this anymore, right? So he's also retiring, and he's in that phase that, how would we liquidate that and what would happen to that, and how would we appoint a professional manager there, right, and things like that. So we are in that journey right now, learning, still very early days, but quite boring journey. I
boring.
I'm
The
not an
euphoria
investor.
is like. So do you think sometimes that it would have been okay had I just kind of walked out of this, and appointed like a professional CEO to run this company and could have done more exciting things, invested time in my hobbies? By the way, do you have hobbies?
I'm building those. I'm building now because I've been always asked this question and I always felt bad when I had to make up answers.
That's actually not true. You don't. I remember that small little rug that you have. You're trying to do the chip and put for the golf practicing. You keep
Thank
putting
you for
videos
putting my
for
leg.
that.
Thank you for putting my leg on the podcast. I knew that was coming today at least once.
Dude, I was like laughing when you put that rug. I was like, you will not in your balcony. Like, you won't be able to use this in the winters. We were like, no.
And you know what? That's what happened. We had to ultimately trash it. You were so right. But I think, so I think it's not like, we are not in that stage right now at LogiNext where I would like to or I can appoint a professional CEO. Plus, I also feel that if I don't do LogiNext, what else will I, right? Because this is what I know. This is my expertise. Sky is the limit. I mean, the more I can execute, the more we grow. I still see that. So it's purely a function of how much can we keep repeating it. And of course, the growth rate and the returns that LogiNext gives me, no other investments give, right? Because most investments will give you starting from as low as 5% to as high as like 50%, like max, right? Like super 50% compounded returns on any asset would be amazing.
In good years.
Like amazing, like solid, right? If you see like Elon Musk has compounded his wealth at 35% over 25 years. Buffett has compounded his wealth at 32% over 50 years. Right? So the longer the period, the lower the more pressure you have on the percentage. But at LogiNext, like in a bad year, we make 50% returns.
Do you think after a point in time, when you have seen this ground and built something which is so personal to you, do you think as a founder there's a fear of relevance? Like, I am here, but then how am I going to be relevant? And if so, how? Do you think that
I've not felt it, but you won't believe. I've seen some people. I think I will feel it at some point in my life. I've not gotten there yet, to be honest, but I've seen people very closely because there are so many people who have sold their businesses for between $100 million to $1 billion 10 years ago, 20 years ago. Somebody sold their BPO business and then moved to Dubai in 2004. Somebody sold their company to a large corporation in 2011, right? Or somebody was a CEO of a large corporation, retired now, and many of them have been like very good mentors and advisors to me. And when I look at the activities they do, I see that void in them, right? They're just trying to find the purpose. They have a lot of money. They have a lot of time, but that's why I would not name them, but I see them very closely and I feel that, wow, they are really at the bottom of their life because they are finding relevance. And they're
struggling to find relevance,
right? And they do so many things. For that, they would do, again, advisory work, and they would be active because they have a lot of energy, a lot of money, a lot of time, but no purpose.
Yeah.
And I strongly have a feeling that I would be that kind of person one day. And I feel bad about it.
If you don't continue to kind of find other things to drive purpose in.
And that's why I feel that LogiNext is good. It's and I'm enjoying it. It's making me more money. I'm required there. Then why not keep doing it until I have energy?
Yeah. Dhruvil, your career, your journey, and all the depth of experience that you've had is amazing. But there's one thing I personally envy you for. It is your partnership with your wife. Okay, and by the way, you were just a stepping stone so that I could have her as my guest on this show today. So I am going to move to the next part where I actually have a session with Lipi, and I want to know what it really took for her to be with you for all these years. We're going to deep dive into that, but before that, let me take some time to set up the setting, and then we can call her over.
It's gonna be
yeah?
fun.
Okay, let's
Thank
do
you.
that. Okay.